Hello. Welcome to my options channel, Options Unlocked. Today we're gonna take a look at an option strategy called a poor man's covered call. What is a poor man's covered call? Well, in order to explain this, we have to look at a traditional covered call. A covered call is when you have like 100 shares of Alphabet. Let's take an Alphabet as an example with a ticker code Google. You have this stock in your portfolio and you're gonna sell a call and receive some income, right? It's an income generating strategy. You're going to see a premium, a credit for selling a call on your shares. That's why it's called a covered call. But what if you don't have 100 shares of Alphabet in your portfolio? Instead, you could buy an option call, a LEAPS. LEAPS, which means long-term equity anticipation securities. You're gonna buy a long-term option call that gives you access to 100 shares. Some sort of a stock substitute, right? Instead of owning 100 shares, all right, in your portfolio. So what I'm going to do, you're going to buy one option call and you're going to sell one option call, like a covered call, right? And it's also called a diagonal call spread. Diagonal referring to different expiration days, right? Our long-term call, 326 days. Our short-term call sold, 25 days. So diagonal referring to expiration dates, different expiration dates, and call spread referring to the spread between the options sold and bought. In this case, our strike price is 165 and 145. So in order to compare those two, a traditional covered call and a poor man's covered call, one leg strategy, you're going to sell one call out of the money. Poor man's covered call, two-legged strategy, you're going to buy one option call and you're going to sell one option call. Buy one in the money and sell one out of the money with different expiration dates, right? And pros, it's a smarter, cheaper than a traditional covered call. Potential high returns due to lower capital requirements. Take a look at what does it cost to buy a long call, a LEAPS, right? It cost you $2,807.5 versus if you had to buy 100 shares of Alphabet. Approximately $16,196, right? Based on the market price. And cons with this option strategy, if the stock drops, your long call loses value. There's a time decay on your LEAPS, right? And the short call could go into the money and your long call could be called away. Therefore, you need to monitor this trade extensively. Yeah, let's take a look at it in Option Strat. How does it look? Here we have it. Our Alphabet diagonal call spread. We bought one long-term call and we sold one short-term. And this is a net debit spread, right? It's a debit spread. It cost us $2,437.5. You can see it here, right? The same number, right? The difference between those two numbers. So we're going to follow and monitor this trade the next couple of weeks. Remember, like and subscribe to this channel, and I'll see you in the next video. Bye-bye.